ever, and welcome back to the channel. Today, we're diving deep into one of the most fundamental and widely used algorithms in the world of professional trading, the TWAP, or time-weighted average price algorithm. If you've ever wondered how big funds execute massive orders without completely crashing the market, this is the secret sauce. We're going to break down exactly what TWAP is, why it's so popular, and how it actually works. Even if you're a complete beginner in algorithmic trading. So, what is TWAP? At its core, the TWAP algorithm is designed to execute a large order, say 10,000 shares of a stock over a specified period of time, instead of dumping all 10,000 shares onto the market instantly, which would cause major price movement against you. TWAP systematically breaks that large order into many smaller pieces. Khaled's lies trading period goal to achieve an average execution price that is as close as possible to the actual time-weighted average price of the security during that period. Think of it this way: if you're rebuying a stock between 9:30 am and 4 p.m., the TWAP algorithm aims to get you the price that an average buyer would have gotten if they had bought the same small amount every single minute. It smooths out the peaks and valleys of intraday volatility, offering predictable, passive execution. Now, why do institutional funds and large asset managers love TWAP so much? It boils down to two key factors: passive execution and benchmarking. First, passive execution is crucial because these firms trade colossal volumes. If they use aggressive, instantaneous market orders, they create significant market impact, driving the price up when they buy or down when they sell, a phenomenon known as slippage. TWAP minimizes this impact by quietly blending into the existing market flow. It's stealth execution, designed to be invisible. Second, benchmarking is essential for measuring performance. Large funds often need to demonstrate to their clients that they executed trades efficiently. The TWAP price serves as a natural, readily accepted benchmark. If the Fund S achieved average execution price is better than the Market S calculated TWAP for that period, they've proven their efficiency. It's a transparent, easy-to-understand metric for evaluating trade quality. But how is the TWAP algorithm actually designed? The basic, vanilla TWAP is surprisingly simple. You decide on the total quantity you need to trade, say Q, and the total duration, T. The algorithm then divides the total quantity into equal slices and executes one slice at perfectly regular time intervals. For instance, if you want to sell 1,000 shares over 100 minutes, the algorithm will execute 10 shares every minute, regardless of what the market is doing. It's purely time-driven. However, in the real world, funds use much more sophisticated variations of TWAP. Often referred to as intelligent TWAP or adaptive TWAP, the simple model has a major flaw. If there is a sudden, huge burst of volume in the market halfway through the day, the basic TWAP ignores it and keeps trading at the same rate. An intelligent TWAP, however, adapts. These adaptive variations incorporate real-time market data, like current volume, volatility, and order book depth, to dynamically adjust the slicing schedule. They might trade more aggressively when the market volume is high, allowing the order to hide better in the noise, and slow down when the market is thin to avoid pushing the price. Some complex variations even look ahead at expected volume curves based on historical data, trading more shares during traditionally busy periods, like the opening and closing hours, and fewer during the lunch lull. The goal is always the same: maintain a low profile while executing the order close to the true time-weighted average price. So, while TWAP might sound basic, the sophisticated implementations are truly masterful pieces of technology that allow the biggest players to move massive quantities of assets without disrupting the flow of the global financial markets. It's the silent workhorse of institutional trading. If you found this breakdown helpful, please hit that like button and subscribe for more deep dives into the world of financial technology and trading algorithms. Thanks for watching, and I'll see you in the next video.